Backtesting. Now we get to the second part of the lecture, where we're going to look at a trading strategy example. And this is going to be a fun part of the lecture, and certainly something that you can follow along and try and do yourself on Excel too. What is backtesting? I'm sure many of you have heard the term before. Backtesting is when we take a trading strategy and see how it would perform using historical data. Essentially, what we want to know is that if I had implemented a particular trading strategy in the past, what would have happened? Right? So you see, for example, we have this Nifty data set, right? We have data of the Nifty index from 2005 to 2011. And now we can use this to do backtesting. And what this means is that we can take a trading strategy and implement it on the index over this time period. And then we can see what would have happened. Would it have been profitable? Would it have been loss-making, etc.? So backtesting is a really important tool. When we're creating trading systems, we rely heavily on backtesting. Whenever we're testing out a trading strategy, whenever we want to see how we would have done, because the best thing we can do whenever we do any strategy is to see how it would perform had we implemented it earlier. And backtesting is the way for us to do that. Now we will learn a lot about this in the technical trading systems module when we learn how to build a trading system. And we will also learn it for the rest of this lecture. We will do an example. So what we're going to do is take a trading strategy and backtest it on our data. So we'll look at the Nifty index data and backtest a trading strategy and see how it does. Now the purpose of this is for you to see how we can use Excel in a real practical way. What we've been doing so far is looking at Excel in a more abstract way, just looking at different functions, looking at different statistical measures, things we can do, but not necessarily actually applying it to, trading and making money. And that's what we want to do now. Because now we've got some tools, we know how to do different functions, we can now apply it and see what happens. Alright, let's carry on. Moving average crossover. The trading strategy that we are going to go through is known as the moving average crossover strategy. Now I have alluded to this one before, and probably some of you would have heard about it, perhaps even implemented it yourself. Let's go through what a moving average crossover strategy is and what it aims to do. Essentially what we have is a trend following momentum strategy. So we remember what a moving average is. A moving average is essentially the average of the price over a particular number of days. We went through this in an earlier lecture. So for example, you might have a 10-day moving average, which tells you the average of the price over the 10 days. And the moving component comes from the fact that we calculate this every single day. So every single day the moving average will change, and it will just take the average of the price over the last 10 days. And we talked about earlier how we have simple moving averages and exponential moving averages. Exponential moving averages give more weight to recent data, whereas simple moving averages just take the simple average of the last certain number of days. So we'll just work with simple moving averages for now. The purpose of this is just to see how to implement a strategy. We're not necessarily advocating that this is the strategy you should implement, but just how to implement it and how to test it. So how does the strategy work? Well, we take two moving averages, one fast and one slow. So faster means shorter, right? So a 5-day moving average is fast, a 20-day moving average is slower. And the strategy works as follows. When the fast moving averages crosses the slow moving averages from below and ends up above, then this is a buy signal. So essentially, whenever the fast moving average is above the slow moving averages, then we should buy. That signals an uptrend. And conversely, when the fast moving averages crosses the slow moving average from above and ends up below, this is a sell signal. And essentially, this will translate into whenever the fast MA is below the slow MA, that's a sell signal. That indicates a downtrend, we should be short. And now let's implement this. So we'll take the following example. We'll take M, which I've designated to be the fast moving average, and N, which is the slow moving average. So we'll take a 2-day moving average and a 100-day moving average, and we'll implement the moving average crossover strategy and see how well it would do. How much money would we make? Alright, let's go to Excel and do this. Welcome back to Excel. What we're going to do now is implement the moving average crossover strategy. We'll use the 2-day moving averages and the 100-day moving average. Now there are a variety of steps to create this, so follow along carefully. If you get stuck, just go back and look at it again. And as I will stress later on, I recommend you try this at home on your own time. Alright, so what we're going to do is assume that we are trading the Nifty. Let's say we're trading a futures contract on the Nifty. So we make money whenever it goes up, lose money if the contract goes down. That is if we're in a long position, and vice versa if it's a short position. So the first thing we need to do is calculate the change in the index on each day. Now we've done this before, so we know exactly what it means. It's just this day's closing price minus the previous. Okay. Now the next thing I want to do is calculate the moving averages of the Nifty index. So in this column I want I'm going to call it MA2, 2-day moving average, and I'm going to say MA100, 100-day moving average. So the 2-day moving average will be equal to the average of the price over the last 2 days. Okay? Now if I copy this down, each of these will represent the average over the last 2 days. The 100-day moving average will represent the average over the last 100 days. So what I will do instead, okay, so here I have B2 to B3, that gave me 2 days. So to get 100 days, I need to average B2 up to B101. So this here is the 100-day moving average. Alright, now let me just go down here and delete some of the values that we probably don't need. So we have a 100-day moving average, so I want to essentially get rid of the last 100 of these. So this one we can get rid of, that we can get rid of, and 100 data points, so up to 1625, let's say. Okay, everything below that I'll get rid of. Okay. Now we have the 2-day moving average and the 100-day moving average. So our strategy was that whenever the 2-day moving average is above the 100-day moving average, we're long position. Whenever the 2-day moving average is below the 100-day moving average, we have a short position. Now this is actually not too difficult to implement. We can use the if function. So I want to create a new column here, call it the position. Now the position is going to be whether we are long or short. So I'm going to use 1 as whenever we are long and -1 as whenever we are short. So let's go through the criteria again of what constitutes a long position and what constitutes a short position. A long position will be whenever MA2, that is the 2-day moving average, is greater than MA100, which is the 100-day moving average. And a short position will be the other way around. So let's say I have if MA2, the 2-day moving average, is greater than the 100-day moving average, then I want 1 for a long position, and otherwise I want -1 for a short position. Okay? Now I just want to wonder why this is showing like this. There we go. Let's now copy this all the way down. So we have ones and minus ones, essentially the ones. Now I'm going to stop here until this is where the data stops for this one. So 1 means we've taken a long position, and minus 1 means we've taken a short position. And now what we will do is calculate how much money we would make for each position. Now this is fairly straightforward, right? Because 1 is long and 2 is short, it means that we just need to multiply the position by the change. So this position in column F times the change in column C. Alright, so this will be profit. This equals the position times the change. Okay, now for some reason it's displaying this as a date. I don't know why. I will just change that to a number there without the $sign. Okay, so we have profit here, and why is this a profit of 21.95? So what we have is that here we have a short position of minus 1, and when we took that short position, the market fell by 21.95 points. So in that case, we're making a profit of 21.95. Okay? Likewise, in this case, we're making a profit of 59.55 because we were short and the market fell on that day. So we have a lot of short positions here, as you can see. So here, for example, we have long positions. So in this case, the 2-day MA is greater than the 100-day MA. And we have our long position. In this case, we've made a profit, and here we've made a loss. So now comes the, of course, all-important metric. We want to look at, is this a profitable strategy or not? So what I can do is go over here and say total profit, and this is just going to be the sum of all of this. Great. So as you can see, this strategy would have made a profit of 10,180 had we implemented it over the 5-year period. Now this is incredibly useful, right? Now we know, for example, that if we take a strategy where we have a 2-day moving average and a 100-day moving average, we will make a profit of 10,000. Which is very good. It's a lot, because if you look at where the market starts, if you see the market starts at about 2,000 and closes at 4,500, so if you just did a buy and hold, you'd make a profit of about 2,000, right? Whereas this, we make a profit of 10,000. Now I want to caution you that this profit, your actual profit would probably be less than that, and the main reason for that is transaction costs. We haven't accounted for the fact that you're going to be spending money every time you buy and sell, and we're not going to go through that in this lecture. When we actually go through trading systems, we'll go through everything that you need to include whenever you calculate the true returns from a strategy. So this is just an example. So just assume for now we have no transaction costs. So I'm not saying go ahead and implement this strategy because we haven't, kind of gone through it completely. This is just, again, part of the Excel tutorial, so we see how to do it, how it works. But what we can see here is that this particular trading strategy gives us this amount of profit. Okay, so now that we've done this, let's carry on with the next part of the lecture. Changing the parameters. So we looked at an example of a moving average crossover strategy whereby we were long whenever the 2-day moving average was above the 100-day moving average, and we were short whenever the 2-day moving average was below the 100-day moving average. Now, one of the main advantages of backtesting is that we can very easily vary the parameters. So why did we take a 2-day moving average and a 100-day moving average? The fact is, there's no good reason for why to take those particular values. You can take lots of different ones, and ultimately you want to see which one works best. So what we'll do now is that we'll go ahead and implement the same strategy. This time we will change the parameters. Right? So we'll try 3 different strategies. We'll try 2-day and a 200-day. We'll try a 5-day and a 100-day, and a 5-day and a 200-day. Right? And we can then see which of these would have been most profitable over the time period. So let's go back to Excel. Okay, here we are back in Excel. So now what we're going to do is implement 3 new strategies. Well, the same one strategy, but with 3 different parameters. Okay, now I'm just going to modify this this table so that it's a little cleaner and makes a little more sense. So what we need to do now is we need the 5-day moving average, and we also need the 200-day moving average. So let's put that in here. Okay, so we'll have MA5, and then we can have in here MA200. Right, so MA5 will simply be the average of the price over 5 days. Yep. MA200 will be the same as this, except it will be up to 201. So that now is the 200-day moving average. Let's just get rid of these for now. We'll do them again in a second. Okay, so now we have the 2-day moving average, the 5-day moving average, the 100-day moving average, and the 200-day moving average. So again, I want to get rid of excess data. So this stops at 1625. We're now going to have to go stop at 1525 because we have a 200-day moving average, right? So we don't want, because we have 1725 data points, we don't want to have a 200-day moving average that's missing points. So this is our last one here. Now what I will do is I'll actually delete all of the moving averages from this point below because we're not going to use them. Okay. So now our profit may be different from the first strategy because we now have 100 less data points. Right. So now we're going to have 4 different strategies. I'm going to implement the same strategy we did last time and 3 new ones. Right, so we have, I'm going to call this P1, which will be position, well, let's do it this way. What we had before was the 200 and the 100. So I'm going to call this P2 and 100. That's position using the 2-day moving average and the 100-day moving average. Then we'll have the position using the 2-day moving average and the 200. Position using the 5-day and the 100. And the position using the 5-day and the 200. Okay, maybe we'll put a POS in here. Might help. Because then we'll have to do profit later, which is also starts with P. Okay. So we'll go to the same if conditions we did before. So if, in this case, it's going to be the 200 and the 2 and the 100. So if the MA2 is greater than MA100, then give us a 1. Otherwise, give us a -1. I think I have an extra bracket in there. Yep. Okay. This was the same strategy we had before. Now the 2 and the 200, again, will be the same as this, except we'll be using the 2-day and the 200-day. So if MA2 is greater than 200, then give me a 1, otherwise give me a -1. Then we have the 5 and the 100. If MA5 is greater than MA100, then give me a 1, otherwise give me a -1. And finally, 5 and 200. If MA5 is greater than 200, give me a 1, otherwise give me a -1. Alright, so let's just format this. So again, we now want to get rid of these data points here. And I also want to format it so it looks a little cleaner. So again, we're just going to have 1s and -1s, right? 1 means a long position, -1 means a short position. And now I'll calculate the profit from each of these. So that's going to be the profit okay, so again the profit will simply be equal to the position times the change. Now I can put a $sign in front of the C. This will allow me to copy it across to here as well. Alright, so now this, for example, is this position times the change. Okay, so here we can see the profit per day for each of these strategies. And now obviously the most important thing is the total. So look at how much would these strategies have made. So let's say I have the total profit for the 100, total profit to 200, total profit 5 and 100, total profit 5 and 200, and then I'm going to have the total profit for buy and hold. Okay, so this is equal to the sum of column L. That's equal to the sum of column M, and so on. And the buy and hold profit will actually just be the sum of that column there. Okay, because essentially all we're doing is, if we have a position of 1 on every single time, and we'll just do this up to row 1525 to have a good comparison. Okay, so what's the verdict? Well, it seems that our first strategy that we tried initially, the 2-day and the 100-day, was actually the most profitable. So we made a profit of 9,000 on that. And then these other strategies, 2-day and 200-day was also very good, made a profit of 7,000. 5-day and 100-day made a lower profit of 6,000. 5-day, 200-day made an even lower profit of 5,000. And buy and hold profit is 2,000. Again, we haven't included transaction costs, but this is just to show you. So clearly from the 4 different strategies, the 2-day and the 100-day seems to be the best one. Okay, so hopefully this made sense, and we've got one more point to discuss with the trading strategy, and so let's carry on. Adding a band. So now what we're going to try and do is adjust our strategy and see if it improves. Now commonly, one of the problem with moving average crossover strategies is what is known as whipsaw. And when the two moving averages are fairly close to each other, they sometimes cross quite frequently if they're very close to each other. And this does not necessarily indicate a change of trend, right? The purpose of the moving average is to identify uptrends and downtrends. And sometimes if they're crossing one another, they're very close to each other, that's not an indication of a change in trend. So now what we can do is that we can add a band, right? So we'll adjust the strategy so that we now trade if the fast MA is above or below the slow MA by 1% or more. Right, so let's think about what this means. So what we're going to do is say that, well, again, if the fast MA is above the slow MA, that's a long. If the fast MA is below the slow MA, that's a short. But now we want to add an extra condition that the fast MA must be greater than the slow MA by more than 1% for it to be a long, and by less, it must be less than 1%, by less than 1% to be a short. Right, so we have this 1% band, and what we do is that when the moving averages are very close to each other, that is within 1% of each other, we don't trade. Right, we avoid those situations. That will be a example where we take no position, and this is to avoid a false signal. So this is just an example of a tweak we can do to a particular strategy. There are lots of tweaks we can do, and we just want to see if this improves the performance or it makes it worse. Right, and this is all part of the backtesting process. So let's go back to Excel and do this. Back in Excel, what we'll do now is implement this 1% band and see if it changes the performance of the strategy. So what I need to do now is create our position, and this is going to be slightly more tricky than previously. So previously what I had was that if one was greater than the other, then take a long, otherwise take a short. So what we're going to do now is I'm going to insert 4 more columns here. Okay. And I'm going to call this position band 2100. Alright. And what we do here is we say that if the 2-day divided by the 100-day is greater than 1.01. So this essentially means is if the 2-day MA is greater than the 100-day MA by more than 1%, then give me a long position. If this divided by that is less than 0.99, so then it's left lower by more than 1%, then give me a short position, and otherwise give me a 0, which is essentially no position. So now I run this, and I can see now I have zeros in here, I've got ones and minus one. So there's some days where I take no position. Right, so now I'm going to just do this for all of them. So just bear with me 1 minute. So here we're going to have the 2-day and the 200-day. So again, same kind of thing, same formula as that, essentially. And I'll copy this across. And again, we're going to have some minus ones, some zeros in there, and some ones. So 3 different positions. And let's do this for the others as well. So this time we're going to have if the 5-day divided by the 200-day is greater than 1.01, then give me a 1. If same expression is lower than 0.99, Sorry, no, that should be a divide there. And give me a -1. Otherwise, give me a 0. And finally, we'll do it for this one. Sorry, I think I made a mistake here. That should be F, not G. Yep, because it was the 100-day. Okay, and this will be for the 5 and the 200. Alright, so again here we're going to have some 1s, 0s, and -1s for all of them. So now we'll do the same thing as before. We'll calculate the profit from each of these. I need 4 more columns. Okay, so this, I'm going to call this PRB2100. Right, so the profit is just going to be the position times, in fact I can just copy the formula across from here. If I copy that, it should give me the position there times C, which is the change. Yep, perfect. So we'll copy this all the way down and across, and we'll just go to the bottom and to make sure we don't have excess rows in here. So we do, so delete everything from these rows down. Alright, so now we have 4 new strategies, this time with a 1% band. So now let's see, let's insert 4 more columns in here, 4 more rows, sorry. And let's see how it does. So total profit for B2100, total profit B2200, so here we're going to have this is equal to the sum of all that. Okay, so let's take a quick look at the results. So what we can see here, actually the most profitable strategy now is when we use a 2-day and a 100-day moving average with the 1% band. This gives you a better result than any of the others. And we can see for both of these, in both these instances, right, having a band made the profit higher in both of these cases than without a band. In this case, having a band made it worse compared to here. Right, this is both using the 5 and the 100-day, and in this case having a band made it better. So all in all, you can see that having a 1% band tends to improve the performance a bit. Now again, you can do things like try it with a 2% band and see what happens, or try it with a 0.5% band. Right, there's lots and lots of combinations we can do. So anyway, here's our trading strategy example, and hopefully this has been useful in learning how to use Excel to test this trading strategy. Let's go back now and we'll just conclude the lecture.